This is your tech news briefing for Thursday, July 28th. I'm Zoe Thomas for the Wall Street Journal. Getting capital for an early-stage startup is crucial if an idea is going to grow into a full-blown business. And venture capital has typically been there, ready to invest. But there are signs of a pullback. In the second quarter of this year, VCs invested around $16 billion in U.S. early-stage deals, typically called Series A and Series B rounds. That's according to data from PitchBook. It's a 22% drop from the same time a year earlier, and the biggest quarterly year-over-year decline in early-stage funding since 2010, with the exception of the second quarter of 2020 during the pandemic lockdowns. So why is this pullback so drastic, and what will it mean for the development of young startups? Joining us to discuss this is our reporter, Berber Jin. Hi, Berber. Thanks for being here.
Hi, Zoe. Good to be here.
So for a long time, we've been hearing about how easy it is to get startup funding. Why are we seeing this pullback now?
The biggest reason is the sell-off in technology stocks in the public market. So startup investors usually look at those companies as a way to price the rounds that they invest in for private companies. And so the broader market sell-off combined with some concerns over inflation and a potential recession is making venture capitalists a lot more conservative about investing in startups.
Early startup funding has typically not been as affected by these stock market dips. Why are we seeing, those companies being impacted in a way we traditionally see with kind of larger, later stage startups?
Yeah, that's a great question. It was interesting. At the beginning of the year when a lot of investors were pulling back from investing in larger companies, a lot of early stage venture capitalists were pretty confident that part of the market would be insulated just because the companies are so young and they're so far away from going public. But I think the pullback in a lot of the large money managers that were pumping up the valuations for startups last year, the fact that they're no longer in the market means that a lot of these earlier companies can't really raise follow-on rounds of funding. And venture capitalists that are backing these younger companies relied on those big rounds and those large markups to generate a paper return on their funds. And so now I think early stage VCs are understandably nervous about backing companies that might not be able to generate added funding in future financing rounds. And so I think the broader slowdown in the market for more mature startups is sort of seeping into the early stage investing environment. And I think generally the sort of nervousness around how severe the cool down in the VC market will be is just causing investors across the spectrum to become very careful in selecting startups to back.
So how are early stage startups handling this?
Some startups are in a tough position because they raised a lot of money at high prices last year before they really developed products that were proven to have traction in the market and be popular with users. So a lot of those companies, they're running out of cash. They don't have stable revenue streams. And what's happening is that they're turning to their existing investors and asking for these emergency funding rounds, essentially trying to get, a few million more dollars on their balance sheet at the same price as their previous round to try and ride out, the sort of tougher fundraising environment. But it definitely puts even these younger companies in a tough spot because it'll be hard for them to raise cash at higher prices than what they raised last year, given how much more discerning investors are being with, evaluating financial metrics and making sure startups hit revenue numbers and have a strong path to profitability. Those things weren't really in the picture as much last year for buzzy companies.
Does that mean the startups are really having to kind of change their strategy, how they run their business entirely?
Now more than ever, startups are facing the pressure to show that they can grow in a sustainable way. I think last year, because companies were receiving so much funding, they were sort of blowing through cash. They were hiring a lot. They were spending a lot on marketing. They were spending a lot on recruiting. Now, what investors are expecting for companies is to show that they can grow, but can grow in a profitable way and show that if the times get tough, they can easily find a way to survive without burning through cash.
So just using the buzziest terms isn't going to bring in the money it used to. You've spoken with investors about this environment. How do they say it compares to previous slowdowns?
This one is really severe. I mean, obviously the venture market is quite cyclical. There are bull markets and then there are market corrections. But a lot of the VCs I've spoken with, and, they'll even say this publicly, like, this is probably the slowest environment they've seen and the toughest fundraising environment they've seen in the last 10 to 15 years. And so I think most venture capitalists are bracing for a tighter market over the next couple of years even. So I think it's definitely a pretty rude awakening for Silicon Valley, especially given the backdrop of the pandemic and low interest rates and how that sort of fueled what was probably the craziest bubble for the startup market in recent history.
Okay, so the slowest and possibly the toughest market for raising money in. But according to PitchBook, VCs had a record in raising funds last year, and they're on track to do the same this year. So what's going to happen with all that money?
I mean, that is an open question as to how that capital will be deployed in the future. One thing that could happen is these funds could start doing deals that involve some debt elements or more investor protections for equity that they buy. You see that a lot in down cycles, and that could be a way in which some of the capital is invested.
So the time of easy money seems to be over for startups, I guess.
Right. Sadly for the startups, and I guess maybe the investors as well.
All right. That's our reporter, Berber Jin. Thanks so much for joining us, Berber.
Thanks, Zoe. I appreciate it.
And that's it for today's Tech News Briefing. If you want more tech stories, check out our website, WSJ.com. And if you like our show, please rate and review it. You can do that wherever you get your podcasts. I'm Zoe Thomas for The Wall Street Journal. Thanks for listening.